Good morning, everyone that was able to join us as we are now beginning of February, and as we sent our December newsletter a couple of weeks ago, we wanted to give a bit of an overview of 2022 in the US market, okay, as well, being able to answer any questions that our clients have. So thank you for joining. The chat and Q&A are currently open, and we'll be able to answer all the questions that you have at the end of the presentation, but feel free to put them, to write them whenever you want, okay? And we are going about to start. Okay, so in terms of what we're going to do here today, we're going to do a brief overview of the market and hopefully spend some time answering questions. Okay, we're going to review the US market, how it's been developing. Then we'll also talk about where is the current outstanding products, how they are performing, and what do you think it's going to be this year. Okay, and then as usual, we'll kind of look at the most recent products and different products that we've seen in the market, so you can have a bit of flavor of for new ideas. So, talking about the US markets, I mean, it's as you saw in our newsletter, it was another record year. We hit 107.9 billion sold in 2022. First of all, I mean, the first quarter of 2022 was probably the best ever, with hit the almost $30 billion sales in 3 months, which was quite substantial. But then it started to decrease to 25 billion in Q2, and we saw again a small decrease in Q3. Okay, what we saw, what it helped this year being a record year was, of course, Barclays rescission process with a $14 billion rescission process, which 12 were on structured notes and remaining on the ETNs. Okay, that means that in terms of sales, it grew 2.73% compared with the record year of 2021. Now, what you saw is that Q4 slightly below. Again, it's also important that within this data, the 107.9 billion, 97 is registered notes, 2% market-linked CDs, and 1% unregistered notes. Of course, we believe we have 100% coverage of the registered notes, but only 50% of unregistered notes and market-linked CDs. So that might change slightly the picture, but I think we believe we have a very good idea of where the market is. But anyway, maybe you have a couple of feedbacks later on within the different players. Even questions on the market-linked CDs, which has been one of the big topics of 2022. Now, in terms of issuers, JP Morgan was the leader of 2022, followed by Citi and Goldman Sachs, all very, very close together. And then followed by Morgan Stanley, who did recover in the last quarter. What we also saw is that UBS has been slightly decreasing their volume, but that has to do a lot with UBS Wealth portfolio, which is mostly auto-callables, because levels and equity performance wasn't there in the last, basically in the almost 9 months of the year. The volumes compared with previous quarters were quite below. Anyway, what is also important to highlight is who is growing, who is doing very well, and you'll see that on the unregistered note, we saw a big increase on BVA, competing a lot on the unregistered notes, but not only. National Bank started to issue some notes, not much, from 17 to 24 million. And of course, JP Morgan was the one who grew the largest on the top 5 issuers. Again, that was kind of against Barclays, of course, because of the decision process, as well as Goldman Sachs, that still grow, but much less than JP Morgan. Also another highlight to CT, who continue to grow, quite impressive. So they finished the year with a 35% increase. Okay. Besides that, you also see Bank of West, their market CDs grow a lot. And on a negative, you can see Barclays, considerable increase, less 67%. BNP also decreased, although that number might be slightly lower as we only cover 50% of unregistered notes. And of course, Credit Suisse also suffered this year in the US. Now, in terms of product subtypes, there are a couple of trends here that we've been highlighting throughout the months, but still, it's good to get a bit of a picture for the year. So capital protected products, okay, experienced a massive growth in 2022 with almost 500% growth. I mean, 2021 was a bad year, interest rates were quite low. So the CDs, market-linked CDs almost disappeared from the market. In 2022, they came back. But what I also find it very, very interesting is that capital protected notes also came up in strength, and we will show you a couple of other graphs that show this. Okay, the other interesting trend is the growth on the growth products. So you can see there on the left chart that as autocallables have not been expiring throughout the last 9 months, as markets, as the strike levels were down compared with the current outstanding products, we saw a lot of growth notes being sold in order to try to get some lower levels or interest levels, potentially higher participation rates. And that's what you can see also on the right table. So on autocalls, Barry Phoenix, Barry Digital, Phoenix also decreased. More on the Barry Digital, as Phoenix, where the autocall barrier starts to go down, were actually quite popular. But on the non-autocall, what you see is that you had a lot of growth on the non-autocall, almost 37% compared with 2021, which is quite impressive. Just a small highlight that we are now covering fixed income rates. Okay, so that's why you see that massive growth from 0 to 9%, but that has to do just with the increase of our coverage on that market. And then the other one is the capped protected participation, who grew from less than 0.1% in 2021 to almost 3.3%. Still small percentage, but quite significant. And you think that if market-linked CDs only represent 1%, that means you have another 2.3% of capped protected participation payoffs being issued as notes. I think that's quite interesting, as interest rates are now higher, because of course you have a higher cost when you issuing registered notes than with market-linked CDs. And of course you have asset classes, and I mean, as the focus was a lot on growth notes, you can see that equity indices continue to drive that 66%. But I think the other trend, which because of volatility was quite high, you can see there considerable is S&P 500 single linked products, which was the top one with 1/3. I'll probably remember 2 years ago, the worst off between NASDAQ, Russell, S&P represented 40% of all sales in 2020. So that goes from 40% to 8%, and a lot of just single S&P 500. Also, is because vol was high. There was a slight decrease on equity share linked products, and in 2022 they only represent 14%. And something which I'll highlight later on is the multi-asset indices. With the coming back of the market-linked CDs, they started to show up. And of course, interest rate products, although we started hiding those as we believe, it's going to be a trend, more investors going to look at. So I would imagine that structured product desks are looking at, floaters, callables, fixed to float, payoffs. We now see that they represent 6% of all sales. And again, we're excluding fixed bonds. Okay, so here we consider all the lightly structured products that I mentioned. Okay, and of course ETFs, which is represented by funds, currently at 5%. But clearly the trend has been S&P 500, volatility is high, interest rates, and the yield curve was also positive. So, the S&P was the most popular trend, and also a decrease on, different sectors like financials, IT, massive decrease. Tesla was the most popular underlying on the equity shares, that decreased very considerably. So, and we're going to talk about the performance. And I must say, so volume was 2.7% up compared with previous year, and partly, as I said, was due to the Barclays decision. Okay, but still, even not considering that, it was a very good year for structured products, mostly for products that were called. And here you can see is the average performance of expired on mature products. So excellent feedback from the client. The average annualized performance this year was almost 14%, more than 13.5% annualized return. Very, very, very good performance. And of course, that has to do with the first quarter, where a lot of these products that were issued during high vol, during the COVID crisis, expired 1 year after with a very, very, very positive performance. You can see there, average performance in March, April, and we're not talking about here 5 or 10 products, we're hundreds. Average performance above 20%. Okay, excellent performance. It started to go down as markets started to go down, and you can see some of on the growth products that had an expiry date and a maturity date last year had negative performance, 2%. But even those beaten the market, they had some buffers and some barriers around 60%. So they still offer some of the capital back. I think the negative performance comes to some products linked to equity shares, Tesla, some of the other US stocks who were hit mostly on the IT sector. And I think that's why we also saw a decrease on the usage of technology stocks. Now, what does that mean going forward? So here, what we do is we track all live products in the US. And it's quite interesting because we show this graph, same graph on the left, so current live exposure in our event back in October. And back then, 40% of the exposure was currently to the Russell 2000. Now, 4 months later, and this data is from 3 days ago, the more than 1/3 of the exposure is currently on the S&P 500. Okay, and you can also see then the underlyings, but you can see 1/3 is the S&P 500. Okay, what is also negative, and I think that's why we are kind of bearish for this year compared with last year, or is that the average product is currently 5-6% below their initial level. Okay, good news is because we still have a lot of Phoenix, so auto call coupon being paid. Clients are still getting some of the interest, okay, but they're clearly below their auto call levels, and I think this is what it brings it to be quite negative for this year. And I think we will see not a new record year from the 107 billion. I think we probably will be above 100 billion, but a slight decrease compared with the total volume issued this year. With the current S&P 500 levels, if the S&P still rallies an extra 5%, then that's another story. We might get a bit of auto calls increasing on Q2 and Q3. But at current levels, even as we did this analysis 3 days ago, even with the small rally we had in January, it's still 5% that needs to be recovered. Okay, and then we'll show you a couple of product trends and what we've seen in the market. Something which is we still say is, as vol is high, at least at the end of the year, you can see on the right graph, the average coupon rate annualized and the average knock-in barrier. And what you see as, well, interest rates are higher, vol is also, it decreased, but it's still considerably high. We saw a slight decrease on the average knock-in, but most important is an increase of the average coupon offered to around 12%. Also because of interest rates, that's something that is happening. And then on the left, you see the average coupon barrier. So we see clearly an increase on trying to guarantee the income as investors or as distributors don't think that this product is going to be called this year, and offering more income product types. And then, of course, the other trend is the capital protected products. I mean, you saw an increase from 2.5 billion back in 2021 to 8.6 billion in 2022. And again, what you see is massive growth on capped protected participation products, and we'll show you an example in a few minutes. But and you can also see the other product types within the capital protected. Okay, the other graph, which is also very interesting, is on the right. Besides the capital protected growth, you can see the quarters and how they're almost insignificant in Q3 2021. It multiplied several times to the end of the year. What you also saw, massive increase on twin win participations. So we're almost, I think there was only 5 products sold in 2021, twin win participation. As vol started to decrease, but it was still high, we saw a massive increase on the products sold twin win, but also on buffered participation. So growth products with a buffer, less increased growth compared with the twin wins, but we saw that increase. And then again, market link CDs coming back. I would say that we always have a lag on the volume sold on the market link CDs, but that gives you an idea of the growth. So potentially the Q3 to Q4 was close to the same, but if we look at the registered notes, capital protected, they definitely grow. In terms of underlyings, Interesting, or not that interesting to most of you, is the comeback of the proprietary indices. I mean, first of all, the one that's been most popular is the Goldman Sachs, followed of course by the Efficiente, Credit Suisse, and the Citi indices, and other with JP Morgan indices. Okay, but to highlight too is the S&P 500, which there were not, the last market, there were no market link CDs back in 2021 linked to the S&P 500 only, and now it's possible. So you can see a massive increase on S&P 500 market link CDs, which are quite easier to sell for financial advisors, capital protected, linked to the equity, the most familiar equity index, offering some participation on the positive. So yeah, that's something that that is definitely growing, and probably will see growing. Then to finish, I'm going to show you a couple of interesting products. The most recent ones. One is this bearish note linked to the US dollar relative to a basket of currencies, capital protected, issued by Citi, quite different because of the being a bearish note. Not at win-win, but just bearish on US dollar. Kind of interesting way to position different asset class infrastructure products, right? Not that popular recently in the US, FX products, but something that quite interesting as they can all offering with capital protection. Okay, and then the other one, which is interested in another asset class, which is commodity linked, also capital protected. There is a reason why we select the two capital protectors, one note and one CD. Of course, they're now coming back. So it's linked to the iShares and S&P commodity indexed one, 3-year note offering 100% participation and 21% cap. And I think it's quite interesting how, if you think about years ago, you couldn't offer something like this. Remember, commodities, no dividend yield, and they still can get, a cap at 21%. So definitely something that we see that will continue to be a trend in 2023. Okay, so this is the overview that we wanted to give it to you. Again, I'll be happy to answer questions that you might have on the data or any questions, but of course we'll share this presentation with all of you. Just to give a couple of more minutes for anyone to ask questions. Just checking. Again, while we wait, just showing a couple of the charts clearly was very interesting. I mean, record year, almost 108 billion. Okay, and of course, growth from the issuers. I mean, JP Morgan did very well. BVI. Okay, we have the first question. What is your prediction for the structured product market in 2023? Another growth year. It's going to be extremely difficult this year, I think. I think we predict at current S&P 500 level that the market will be down probably around 5%. So they'll sell around 103 billion dollars. That's with the current level. Actually, to give you also a better idea, so we tracked when going to expire more products, with April and November being the highest months. That's where there's a lot of products expiring. a lot of growth notes that will expire kind of below initial levels, so giving back the capital. Okay, but of course, if the S&P 500 goes up an extra 5%, that might change. That might go from 5% decline to be flat if you go 5%, especially if it goes on Q2, where there is a lot of autocall observations. If market doesn't rally an extra 5% before Q2, then it definitely will be below the current last year. Okay, I think we answered the question. Just checking if there is any other. No? Okay. Look, thank you everyone for joining. Again, we'll share the presentation. I believe you already have the December newsletter, but we'll send this around. And yeah, if you have any questions, feel free to email any of us. Thank you.